The bank account error that's costing you $1,840 per year. Your checking account pays 0.01% interest, while inflation runs at 3%. Every $10,000 sitting in checking loses $300 in purchasing power annually. But here's the bigger problem. You're probably keeping way more money in checking than you need, missing out on 4% to 5% high-yield savings rates. The average person keeps $8,000 in checking when they only need $2,000. That's $6,000 difference. Earning 4.5% instead of 0.01% is $270 per year. Scale that to your actual balances, and most people are losing $500 to $2,000 annually. I'm about to show you the exact account structure that maximizes your interest while keeping your money accessible. The checking account trap. Banks love it when you keep large balances in checking accounts. You get nothing. They lend your money at 7% to 25% and keep the profit. Most people keep 3 to 6 months of expenses sitting in checking just in case. That's $10,000 to $25,000 earning essentially zero interest, while it could be earning $400 to $1,125 annually in a high-yield savings account. The checking account trap happens because of inertia and fear. Your direct deposit goes to checking, you pay bills from checking, and you leave the rest sitting there because moving money feels complicated. It's not, and the cost of not fixing this is massive. How much should actually be in checking? The rule is simple. Keep 1 month of expenses in checking maximum. Everything else should be in high-yield savings or investments. If your monthly expenses are $4,000, keep $4,000 in checking. That covers all your bills, groceries, and regular spending with a small buffer. Everything beyond that, your emergency fund, short-term savings, money you're accumulating for a goal, belongs in high-yield savings earning 4% to 5%. Right now, the best high-yield savings accounts are paying 4.5% to 5% APY. Online banks like Marcus, Ally, Capital One 360, and Discover offer these rates with no fees and no minimums. The real cost of keeping too much in checking. Let's compare two people with the same $15,000 in cash savings. Person A keeps everything in checking. $15,000 in checking at 0.01% APY. Annual interest earned $1.50. After inflation at 3%, lost $450 in purchasing power. Net result, $15,000 can now buy what $14,550 could buy last year. Person B, optimal structure. $4,000 in checking at 0.01% APY equals 40 cents interest. $11,000 in high-yield savings at 4.5% APY equals $495 interest. Total interest earned, $495.40. After inflation at 3%, $15,000 times 3% equals $450 lost to inflation. Net result, earned $495, lost $450 to inflation, came out $45 ahead. Person B is $493 better off than Person A just by moving money to the right account. Now scale this to someone with $30,000 in savings, keeping it all in a checking account. They're losing $1,350 per year compared to the optimal structure. My $847 annual gain. 3 years ago, I had $22,000 sitting in a checking account paying 0.01%. I was losing $660 annually to opportunity cost, plus another $660 to inflation. I opened a high-yield savings account at Marcus, paying 4.3% at the time. I moved $18,000 to savings and kept $4,000 in checking. First-year results. $18,000 at 4.3% equals 774 interest earned. 4,000 at 0.01% equals 0.40 interest earned. Total interest, $774.40. Compare that to leaving $22,000 in checking at 0.01%, earning $2.20 annually. I gained $772.20 in year one just by moving money to a different account. Current rates are even higher at 4.5% to 5%, so the gains are bigger now. The 3-account structure. Here's the account setup that maximizes interest while keeping money accessible. Account 1, primary checking. 1 month of expenses. Used for bills, groceries, daily spending. Can be a traditional bank if you need branches, or online bank for higher interest. Link to all autopay bills. Account 2, high-yield savings, emergency fund. 3 to 6 months of expenses. Earns 4.5% to 5% APY. Accessible within 1 to 2 business days. Only touch for true emergencies. Account 3, high-yield savings, goal-based. Short-term savings goals, vacation, car down payment, home repairs. Also earning 4.5% to 5%. Separate from emergency fund for mental accounting. Some people add a 4th account, a brokerage for investing surplus beyond emergency fund and short-term goals. But the 3-account structure covers most people's needs. How to set this up in 30 minutes. Open a high-yield savings account online. Top options right now: Marcus by Goldman Sachs, Ally Bank, Capital One 360, Discover Bank, American Express Personal Savings. The application takes 10 minutes. You'll need your Social Security number, ID, and the ability to verify via a small deposit from your existing bank. Once approved, transfer everything except 1 month of expenses from checking to your new high-yield savings. Set up a small automatic transfer of $25 to $100 per month from checking to savings to build the habit. Link your high-yield savings to your checking for easy transfers when needed. Most transfers are complete in 1 to 2 business days. That's it. 30 minutes of work for $500 to $1,500 in additional annual income. The I need it accessible myth. People say, I keep money in checking because I need it accessible. High-yield savings accounts are accessible. Transfers to checking take 1 to 2 business days. For 99% of expenses, that's fast enough. If you truly need instant access, like same-day emergencies, keep $500 to $1,000 buffer in checking beyond your monthly expenses. The rest still goes to high-yield savings. The real issue isn't accessibility, it's inertia. Moving money feels like effort, so people don't do it. But $500 per year for 30 minutes of setup is $1,000 per hour of work. That's worth it. Common mistakes when switching. Mistake 1. Keeping an old account open and unused. Close your low-interest savings account after moving money. Having multiple accounts you don't use is confusing, and you might accidentally leave money earning nothing. Mistake 2. Not updating direct deposit. If your direct deposit goes to checking, that's fine, but set up an automatic transfer to move excess to savings every payday. Mistake 3. Forgetting about minimum balances. Some banks charge fees if checking balance drops below a threshold. Make sure you maintain whatever minimum is required or switch to a no-fee account. Mistake 4. Choosing savings accounts with withdrawal limits. Federal law used to limit savings withdrawals to 6 per month. That's been suspended, but some banks still have limits. Choose accounts with no withdrawal restrictions. Mistake 5. Not reviewing rates annually. High-yield savings rates change. The 4.5% rate today might be 3% next year or 5.5%. Check annually and switch if you find significantly better rates. The compound effect over 10 years. Let's look long-term at the cost of keeping too much in checking. Scenario 1. $20,000 in checking at 0.01% for 10 years. Total interest earned, $20. Inflation erodes 30% of purchasing power. $20,000 has the buying power of $14,000 after 10 years. Scenario 2. $20,000 in high-yield savings at 4% average for 10 years. Total interest earned, $9,604, compounded annually. New balance, $29,604. After inflation, worth about $20,720 today's dollars. You're $6,720 better off in real purchasing power. The difference between these two scenarios is $6,700 over 10 years. That's a free vacation, a car down payment, or a major financial cushion, all from just putting money in the right account. What to do this week? Log into your checking account and see your average balance. If it's more than 1 to 2 months of expenses, you're keeping too much there. Research high-yield savings accounts. Compare rates at Marcus, Ally, Discover, Capital One, and American Express. All are FDIC insured and reputable. Open a high-yield savings account. The application is entirely online and takes 10 minutes. Transfer excess funds from checking to your new savings account. Keep only what you need for monthly expenses. Set up automatic monthly transfers to continue building savings in the high-yield account. Check your savings rate annually and switch if better options emerge. If you found this valuable, hit that like button, subscribe, and ring the notification bell. I drop new finance strategies every week that most creators won't tell you about. Also, visit Own Your Finance blog for more in-depth financial tips and hacks, whether it's banking optimization, savings strategies, money management, and more. Don't forget to download my free guide, Finally Break Free from Living Paycheck to Paycheck, the simple 10-step budget that actually works, and start building real wealth today. Don't miss it. Thanks for watching and have a great day.